The Intricacies of Interest Rate Spread, Banking's Primary Revenue Driver by Dr. Pooyan, Ghamari, Swiss economist. In the vast, intricate world of banking, the concept of the interest rate spread stands out as a foundational principle. It serves as the bedrock of traditional banking revenue, driving profit margins and influencing financial strategies. But what exactly is the interest rate spread, and why is it so crucial for banks? Understanding the basics. The interest rate spread is essentially the difference between the interest rate at which a bank borrows money and the rate at which it lends. In simpler terms, it's the gap between the cost of obtaining funds and the price at which those funds are lent out to borrowers. Two sides of the coin: deposit and lending rates. Deposit rates. Banks offer interest to depositors as a reward for keeping their money with the institution. Whether it's a simple savings account, a term deposit, or a certificate of deposit, these rates tend to be relatively low. They represent the bank's cost of acquiring funds. Lending rates. On the flip side, when banks extend loans, be it personal loans, mortgages, or business credits, they charge an interest rate. This rate is invariably higher than the deposit rate, reflecting not only the cost of funds but also other costs, including operational expenses, risk premiums, and the desired profit margin. Factors influencing the spread. Several factors can influence the interest rate spread, including monetary policy. Central banks, like the Swiss National Bank or the Federal Reserve, set base rates which influence the overall interest rate environment in a country. A hawkish policy, raising rates, can widen the spread, while a dovish approach, lowering rates, might narrow it. Credit risk. The risk associated with a borrower not repaying a loan plays a part in determining lending rates. Higher perceived risks justify higher interest rates to compensate for potential defaults. Operational costs. Banks have overheads, from staff salaries to infrastructure. A portion of the lending rate covers these costs. Market competition. In competitive markets, banks might reduce their spread to attract borrowers, foregoing higher profits for increased market share. Why is the spread essential for banks? Simply put, the interest rate spread is a primary indicator of a bank's profitability. A wider spread usually indicates better profit margins, while a narrow spread might suggest tighter margins and less room for error. It's this spread that helps banks cover their operational costs, compensate for potential loan losses, and ultimately generate profit. In understanding the nuances of the interest rate spread, one gains insights into not just the workings of banks but also the broader economic environment. It's a testament to the delicate balancing act banks perform, juggling depositor interests, borrower needs, and institutional profitability.